Hello everyone and welcome to This Week in the Markets. Last week, Hurricane Sandy swept through the East Coast in US and caused the New York Stock Exchange and Nasdaq to shut down on Monday and Tuesday. So we'll spend a bit of time discussing the damage and effect of the hurricane on the economy. Then we'll look at the economic data released last week and the avalanche of data to be released tonight and tomorrow and how it could potentially affect the upcoming election. But before that, I'd just like to share with you our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So Hurricane Sandy shut down Wall Street for 2 days in a row on Monday and Tuesday. This is the first consecutive shutdown due to the weather effect since 1880 and has disrupted trading in US equities and options. By about Wednesday, the storm passed and the market reopened for trading yesterday night. We do not know yet the degree of damage caused by Sandy, but it is estimated that it would result in insurance claims of about $5 to $10 billion and economic damage of about $20 billion. This is significantly more than the damage caused by Hurricane Irene last year and puts it amongst the 5th most costly hurricanes in US. However, generally natural disasters like this does not cause long-lasting effect on the economy because the recovery spending that follows generally helps to recover some, if not all, the economic activities lost during the closure. Nonetheless, there could be a timing difference. For example, Hurricane Katrina took a toll of over $100 billion on the US economy in 2005 and caused the quarter immediately after the storm to contract, but then the economy bounced back up even faster the quarter after and it's back on track again. Given that the market is forward-looking, we don't expect there to be too much downward pressure on the overall equity markets. This is not to say that there will not be an effect on individual stock at all. More specifically, we think insurers could take a temporary hit due to a short-term surge in claims. Home builders like Home Depot, on the other hand, would likely get a boost from post-disaster repair of doors and windows. Consumer staples will probably see a surge in sales due to emergency stocking, and restaurants could see increased activities, whereas consumers' discretionary sector could see reduction in retail activities, as many shops are closed during the Halloween period, when shopping usually are quite strong. This is still not going to have a long-term impact on the stocks, but it might affect the earnings for the coming quarter. Other than Hurricane Sandy, economic news have been pretty good. The durable goods reports for September came in at 9.9%, and that's 3% more than expected, and a stark improvement from the fall of 13.1% in the month before. This is a positive indicator for the manufacturing sector in US, and we could potentially get more confirmation tomorrow when the ISM manufacturing PMI is released. And the initial estimate of the third quarter GDP suggests a 2% growth rate, slightly higher than the 1.9% expected, and is quite an improvement from the 1.3% in the second quarter. While it is nowhere near a stunning growth yet, it is definitely not the doom and gloom story that we're led to believe by the media. Also, the GDP Purchase Price Index was significantly higher than expected, at 2.9% instead of 2.0%. This is arguably a more general way of measuring inflation than the Consumer Price Index, as it is not biased towards the fixed basket of goods and services. As you can see from this chart, it is approaching one of the highest levels in the past few years, and thus suggests that inflation threat is once again on the horizon. And tonight there will be an avalanche of data reporting, most of which will be reporting before the US market opens. Amongst the data to watch out for would be the ADP employment report, the manufacturing PMI from market and ISM, the weekly jobless claims, the construction spendings, and the consumer confidence. And perhaps the most important of the lot is the ADP employment report, which will give us a prelude to the non-farm payroll on Friday. However, that could be a new source of uncertainty this month, because it is reported that Automatic Data Processing, the company that prepares the report, has revamped the formula it used to calculate the monthly jobs created in the private sector. As this is the first report issued using this new formula, analyst guidance may be in for a surprise, and we could potentially see the report coming in significantly below or above the expectations. The good news is, however, that this new method of calculating jobs is supposed to be more accurate in predicting the non-farm payroll, and therefore that we should see less volatility on Friday, as most of the non-farm payroll should be expected already if this new formula works. And next week we'll enter into election on Tuesday to decide whether Obama will receive a second term in presidency or whether Romney will take over the role as US president. While this is a big event for America, obviously, and could have long-term consequences, we do not expect it to have much negative impact on the market in the short term. That is because currently Obama is leading the poll, even though just by a slight margin, as Americans reward him for his quick response over Hurricane Sandy. If he receives a second term in presidency, the market would already be used to his behavior already, and there's no uncertainty there. On the other hand, if Romney wins, there is an uncertainty about how well he could manage the economy in the future. But according to the previous reactions after the three debates, it seems like the market is actually pro-Romney, and as he promises to cut taxes for corporations and to reduce regulation to increase competitiveness. So either way, we think the market would be at least confident that the uncertainty is now out of the way, and it could also help to speed up the agreement on the fiscal cliff. And this also stresses the importance of the unemployment report on Friday, as this is a critical factor in the upcoming election. So either way it is, we think that it's not going to have too much a negative impact. If anything, the market will probably have a relief rally after that. And that's all the updates that we have for today. We'll have another update next week, and until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.